Many traders like to find ways to short tops and buy the bottom, so they seek out price action reversal strategies so they catch the turns. Now there's a time and there's a place to use a reversal strategy, and the key is to know when that move is failing. Now more often than not, the stronger trend will assert itself, and if you're not using appropriate risk measures, you could be looking at a loss much greater than anticipated if the move fails with some strength. So it's vital to understand when a move is not playing out as expected and to take appropriate action to avoid an unplanned loss. This Forex pair has been a steady downtrend for a year, and that's time frame dependent, of course. And after a strong push down of 14%, price began to consolidate. And after swings were registered, we were able to start a trend line on the bottom of the price. Now I left out the top trend line that would form a channel to keep this example pretty focused. And I've also left out many fanned trend lines except for the small red initial line. Number one, price puts in a clean double bottom pattern that starts the drive to take out the swing high on the left. And after the high is registered, price begins to fall. Number two, price halts in the area of the previous double bottom, and that is a fairly clean, although a low volatility move away from the level. And we're also able to connect two swing points for our demand line. Number three, after another clean rejection just to the right of the number two label, price rallies. And after putting in a higher high, which is an uptrend pattern, price drops to reject off the previous low, giving us a double bottom and an obvious bullish reversal candle. Number four, price makes a tentative approach to the demand line. Now price action would point to the low interest at this point and probably a hold of support just by looking at the price action. And 5 days of Canadian dollar gains are wiped out. Now in all of these cases, there was never a warning shot given as price approached support that we would lose the level. And now if there was a trend channel drawn, you can see that trading this range would not have been too difficult, although real time may have caused you some issues. So a great way to read price is to ask yourself what should happen if A happens. An example of this is number three. Price found support and rejected with a pin bar and then two bull candles right after, which broke highs. Now that's a true sign of strength and something you'd expect to see given the context of the play. But what if that pin formed and price didn't move? As price once again approached the demand line and previous low rejection with strength zone, price begins to consolidate. It's a hard fought battle and the last highlighted candle breaks support. Now not shown, but on the 1 hour chart, you can see how that candle formed. It had bearish implications as price broke to the upside of the consolidation first, and then it broke support. Is that important information? Well, there are a few ways that candle could have formed, and would it change your opinion of the support break if price broke lower first and then took out the high of the consolidation? So that's some food for thought there. So we get the obvious pin bar, and what would you expect to happen? Number one, would you expect consolidation, or would you expect a clean rejections like the previous ones? Number two, would you expect to see the large bear candle if this was a really strong area of support? Now, these are the types of questions you've got to ask yourself in real time. And forget that Canada was set to release interest rates news that next day, and they held on the rates. But just looking at price would not point to strength. Now, reading the price action would alert you that the bulls are in jeopardy, and a long play could get painful. And to be fair, the pin bar reversal strategy would have had you playing long at the break of the pin. It's called a fakie. I never liked that name. Price is seeking volume. And clearly there was buying interest prior to that break. Was that momentum red candle brought to life by those hitting the exits when price did not soundly reject the low and trade back inside the range? Now, I'm sure there are quite a few people boasting that they took part in the quick upside move because they read the pin bar play. However, price action was not pointing towards upside at that point before the news release. In fact, the day before closed on its lows, eating up the pin buyers and those that came before it. Now, I'm going to be transparent. I was set to play the upside move, and I canceled my order when there was no follow through and we had momentum to the downside. There was no trade for me, and the trade was not simply because there was a pin bar, it was context, and I read it as a failure test of the lows. So where are we now? Who knows? I don't forecast, and I just trade what I see. Will the upwards move continue on this massive volume relative to recent history? This is the Canadian dollar futures. Or since the market likes to hurt the most people, will it turn and take out the long heavy candles we just formed? Well, the trick is just let price action tell you the story. You just read along. Up your chances of finding success trading options with your free 6 breakthroughs to winning at options report. Straight from the mouth of an options trading veteran, You are going to learn his plan of attack when looking to take a position. He also wants to share his top 15 names to trade, so you no longer will be spending hours chained to your desk poring over the many choices that are available. Just click the link, enter your email address, and you'll get immediate access to this highly specialized options report. Totally free.